1998, there were 16 armed conflicts in Africa. Today, there are 3. If you look at Mozambique and Angola, where we are present as an organization, they've had a huge dividend once the war wound down. Significant spur in economic growth once the war sort of turned down. So I think the democracies are maturing with social media and everything else. I think the days of power through dictatorships in Africa is a thing of the past. And those democracies are maturing now. The 5th is the economic governance model. So Africa in the 80s and the 90s had very high foreign debt to its GDP. So, for example, at that time in the 90s, Africa's average foreign debt to GDP was roughly 89%. Today it is 52%, dramatically low. Africa's total debt to GDP is now about 30% on an average across the sub-Saharan African countries. That is incredible if you compare it with the US or Japan or Europe. It's extremely good. In the 90s, Africa had current account deficits, significant double-digit current account deficits. Those are now current account surpluses on the average for Africa because net terms of trade has improved across the continent. You had a situation where you had fiscal deficits in the 90s of about 4.6%. Now the average fiscal deficit in Africa is about 1.8%. So from a macroeconomic governance and macroeconomic stability point of view, Africa has come a long way from where they have been in the past. The big issues today in Africa is really a huge infrastructure deficit. So even if you compare Africa with other developing economies, so the BRIC economies, if you look at the BRIC economies have 5 times more roads in terms of intensity of roads in terms of per 1,000 kilometers, and about 2.5 times more rail intensity, and about roughly 2.5 times more power intensity. So still in Africa, availability of potable drinking water or electricity or power, there are large parts of Africa where there is a massive and significant infrastructure deficit. Therefore, investing in Africa comes at a higher cost because most companies will build that infrastructure themselves. So if you're setting up a large manufacturing facility, you will invest in building that infrastructure yourself in terms of your own captive power plant or any of the other utilities that you need to make sure that you have uninterrupted capacity to produce. So the costs in terms of infrastructure deficit is quite high. The second is availability of talent. There's going to be a significant growth in the educated youth in Africa. So the forecast is that more than 40% of the youth population will have a secondary education, and about 14% of them will have tertiary education by 2030. So you will have not only the issues that we are facing today now in terms of getting good quality talent and therefore having to have a mix of both expatriate and local talent and do capacity building over time in Africa. I think over time that will begin to change. But today there is a talent deficit and we have to therefore supplement the local talent that is available, invest in building capacity, but also bring in people from outside. Africa, although I said there's maturing democracies and there are more elections, etc., still there is high political and sovereign risk. And therefore you need to find a way of mitigating the political and sovereign risk. You can lay off that risk in the insurance market. We do lay it off in the London market. It protects us against forced nationalization of our assets, selective discrimination against foreign investors, forced abandonment of our assets, a military strife, civil war, coup, any of these political and sovereign risks, we can lay that off. And secondly, we need to be diversified. So today OLAM is present in 24 out of the 44 sub-Saharan African countries. No country today has more than 8% of our total assets. So apart from taking an insurance cover, we also remain diversified in terms of not concentrating all our investments in any single country. But it's important to be able to invest deeply in a country to get the kind of advantage that we are seeking in Africa. So today, we employ roughly 8,100 people in Africa. We are in 24 countries. We have about 40 companies there. We have over 53 factories. We have over 300 warehouses because we do farm gate upcountry sourcing. And in addition to that, we employ about 14,000 people on a seasonal basis because a lot of the farming activities are seasonal. So when we invest in Africa, we invest across 4 themes. The first theme that we invest across is really where we see Africa as a cost-competitive producer of certain resources or commodities. So that is why we are investing in palm in Africa in a big way, because we believe that over the long term, Africa will have a competitive advantage in producing palm cheaper and better compared to the other competing producers. And that is why we're investing in rubber, because we believe Africa will be the lowest cost rubber producer in the world going forward. When you go upstream into farming and plantations, it is very difficult for anybody sitting in this room to tell us what palm oil prices are likely to be 10, 20, 30 years from now. We will all make a careful supply-demand analysis and have some idea of where prices are likely to head in terms of direction. But at the end of the day, when you're going to put up $500 million to invest in a 50,000 hectare palm plantation in Africa, there's a massive speculative judgment that you're making, that commodity prices in palm are going to be trending in a particular way. But most planters, when they take an investment decision to plant new plantings, take that on the basis of whether they can build a cost structure that is globally competitive. If they can have a cash cost of production and a capital cost of production configuration in a way that they will have a cost structure below the marginal cost producer's cost of production, then they are unlikely to be unprofitable even across deep down cycles in those commodity markets. Because typically, if you look at last 200-year price history in commodities, you will see that the commodity prices don't go below the marginal cost producer's cost of production for a material period of time. It will cyclically dip below that, but it will come back above that marginal cost producer's cost of production. So all that we can do when we invest capital and allocate resources is to make sure that we have a cost structure that is below the marginal cost producer's cost of production. I can make any plantation investment very sexy on a spreadsheet. I can just tweak around a little bit with OERs and prices, and I will get any IRR that I want. That is not relevant. What is really relevant is, can you put your hand on your heart and say that you got a capital cost structure in developing this plantation, a cash cost structure in developing this plantation that will allow you to be having a competitive advantage. Then in up cycles, you'll make significant sums of money. In normal cycles, you'll make good money. And even in deep down cycles, you will be profitable. It is not that in all commodities, you will always have a situation in a very deep down cycle that the producer can still be profitable. But if you have a true competitive advantage, then you can be profitable most of those times. So I just want to move on to the second part of my presentation, which is really talking about the long-term agricultural trends, because that has a direct impact on long-term palm trends and therefore the opportunity of palm in Africa. So if you look at the last 15 years of this century, you will see that we had 3 food price crises. One in 2008, June, when the FAO food price index went to 225. And then another one in September of 2011, when it touched 235. And then another one in September of 2012, when again the food price index was about 215. Now, if you look at the historical juxtaposition of what happened in the last 15 years, if you look at the first 4 years of this century, 2000 to 2003, you had the FAO food price index range between 90 and 98. And in the subsequent 4-year period, till 2007, it ranged between 112 and 159. And then in the last 6 years, it has breached the 200 level 4 of those 6 years in terms of an average. And there have been peaks in between the year, but on an average it has breached. And if you look at McKinsey's global commodity price indexes, and they follow across multiple commodity asset classes, energy, metals, etc., and agriculture, and within agriculture, they track the prices of various commodities. And they classified their study into two halves, between 1980 and 2000, and between 2001 and 2013. So between 1980 and 2000, if you look at wheat prices, it declined 37%. Between 2001 and 2013, wheat prices went up by 208%. Corn prices declined 22% between 80 and 2000, but it went up 223% between 2001 and 2013. Rice prices declined 47% and then went up 132% in the subsequent period. Beef prices declined 32% and then went up 117% after that. Cotton prices declined 50% but went up 111% after that. So if you see, after 2000, the whole 20th century 100-year period, we had real decline in commodity prices. Overall, the entire commodity complex, including energy, metals, agriculture, declined about 50% during that period, 100-year period. So 0.5% a year, 50% through that 100-year period. And within that, agriculture declined by about 70%. Now, if you take the 17-18 liquid agricultural commodity contracts traded across the exchanges globally, you will see, barring one, which is lumber, 17 out of the 18 commodity contracts, current prices, which are fairly low in some categories, are still higher than the 5-year average, 10-year average, and 20-year average prices for all of these commodity contracts. So clearly there has been an inflection point, and while we are seeing a cyclical correction now, the long-term structural trends are unmistakable. There's about $6 trillion worth of farm gate production value of the various commodities that we produce. Proteins and fats is the biggest category, $1.65 trillion. And then you have fruits and vegetables at about $1.6 trillion. Then you have grains at about $1 trillion. And all the other stuff, the softs, cocoa, coffee, cotton, edible nuts, spices and vegetable ingredients, tea, tobacco, all put together is about $580 billion. And then you have the oilseeds complex, which is about $380 billion. Out of that, palm is roughly, including its derivatives, $75 billion. Farm gate value 45 plus derivatives about $75 billion. And then you have forestry and forest products, which is about $500 million. But if you look at the last 2007 onwards, this has grown at 8.4% on an average. Volume growth has only been 2.5–3%, but the price growth has been contributing the balance 5–5.5%. So overall, this complex between 2007 and today has grown at a CAGR of roughly 8.4%, split in that form. So if you look at the major trends, obviously population growth, we have 7 billion people, 7.2 billion people today. It took us all of mankind to get to 1 billion people in 1800, and then 130 years we doubled it to 2 billion. So 1930 we were 2 billion. Then it took us 30 years to double it to 3 billion. So 1960 we were 3 billion people. Then it took us 14 years. So 1974 we were 4 billion people. Then 13 years to become 5, and then 12 years to become 6, and 12 years to become 7. And we will probably take another 14 years to become 8. And then 9 and 9.55 billion people. So about 80 million people are being added to the world population each year at current population growth rates of 1.1%. But UNDP forecasts that by 2030 population growth rate will halve from the current 1.1% to 0.47%. And if it halves, then we will expect a population of about 9.55 billion people. So all of them need to be fed. And second is, we are seeing a significant growth in the middle class. 1.8 billion people in the middle class in 2010. And in the next 20 years, that is going to grow to 4.88 billion people. So we're going to be adding 3 billion people to the middle class. And I told you that means increased calorie consumption. It also means significant expenditure for other things. For example, for cars, and urbanization has a role to play as well, and which is why it is important, because farmland in a lot of these growing countries will compete with rubber, right? And therefore, when you're forecasting increased potential supply of palm, there's also going to be a view that you have to take on how the long-term supply demand for rubber is going to look like. And today, China has 60 million passenger cars in its population. The International Energy Agency says that it will grow to 400 million by 2035. From 60 million to 400 million. Between 2000 and 2010, China's car population intensity, that is, number of cars per 1,000 people, grew tenfold. From 4 cars per 1,000 people to 40 cars per 1,000 people. The world average is 150 cars per 1,000 people. The US is at 790, 800 cars per 1,000 people. When Chinese car population goes to 400 million, it will still be 310 cars per 1,000 people. still significantly lower than much of Europe, much of Japan.